I'm seeing a lot of news about Neo that's positive, even though the stock hasn't been doing great. And actually, here's a great example of a Morgan Stanley analyst saying it's time to load up on Neo stock. And we're going to take a look at the company financials and see if that holds any weight. Here is a look at the stock since it IPO'd in 2018. It's did really well here, and then it did not so well here, and is currently sitting at 558. And analysts are saying it's going to go as high as $7.08 is the price target 1 year from now on average. And let's see if it's time to load up on Neo. If we head down here, we can see their income statement. This is where all the fun happens. So if we go to annual, we can see that their revenue has been trending up, which is really good. Their net income has kind of been sideways over here and then took a deep dive here. But that's not a concern. I believe they're just investing in growth right now, so that's not super, super bad. But all we need to know is in the balance sheet. If we go to annual balance sheet, we can see our assets and liabilities over time, both growing pretty much similar ratios here as they grow, which is not bad. And if we take a look at their debt to equity ratio, liabilities divided by total equity, we get a debt to equity. We get a debt to equity of about 3, which normally is a big red flag. If it's above 1, or specifically higher than 2, it means that a company could be going bankrupt. But in this case, when you see a stock crash like this, as the stock goes lower, your equity becomes smaller, and that means your debt to equity ratio goes higher. And so it's not always indicative of a problem. And in this case, I don't think it is, because if we look at their cash and short-term investments, we see 50 billion. And when their total liabilities are almost 90, I mean, they could cover half their liabilities just in cash and short-term investments if they really wanted to. And I don't think they're going to struggle to make interest payments on those liabilities. So that part's really good. And it's backed by their total assets of 117 billion, which is a lot more than their liabilities. So in terms of assets, cash, and short-term investments, I don't see a problem. I don't see why that they're not going to be able to pay back these liabilities, even with a debt to equity ratio of 3, which is quite alarming. But I think that if we start to see some more positive news come out of Neo, some more anticipation and some growth, that we can expect to see the share price start to come up into this $7 to $9 range in the short term. I don't think that's much of a stretch. I'm liking what I see so far. Normally, like I said, this would be the liabilities to equity ratio would be a big red flag, but because they have so much assets and short-term cash, I'm not super concerned about that. So I personally don't own this stock, but hey, it's probably not a bad buy right now. That Morgan Stanley analyst is probably right on the money with the load up, but as always, we're going to have to wait and see what this does.